Steve, earnings, Fed easing. That's the bull thesis right there in front of you. Anything to hit at on that?
Well, let's simplify it. Don't fight the Fed. So whether the Fed goes in October, whether they go again before the end of the year, and there's some debate about that as the economy continues to look strong, and we've seen somewhat a moderation in inflation, meaning it's not ticking up. The last couple of numbers came in okay. So, look, while I don't think anybody's happy with valuation, we heard Tepper come on network last week and say that. So this is truly a hated bull market because valuation is where it is. There's no reason to believe that as we go through earnings and we're not seeing the revisions, that it won't take it another leg higher. And I think that's what will happen.
But that'd be good.
That'd be very good.
You know what I'm saying? If earnings are the thing that takes it higher?
Exactly.
You're not just talking about multiple expansion here. You're talking about earnings growth.
And we're not talking about earnings growth based upon an easing by the Fed. So when you add the Fed easing, you'll potentially put that in hyperdrive. And then we can talk about a year out. What's it actually mean for inflation? That'll be very inflationary. But now you got to dance while the music's playing.
Yeah, market doesn't care about anything way out, right? Tunnel vision. You play the cards that are in your hand, and the hand looks pretty good, doesn't it?
Well, the hand looks pretty good in the short term. And I think the most hated bear market, that's where I sit. It's the most hated bear. Oh, sorry, the most hated bull market. Thank you.
You talk about it like it's a bear market, but actually it's been a bull market.
Well, it's uncomfortable. And I don't know anyone who's not uncomfortable. And so the way I look at it is clients are constantly asking me, is it too high, blah, 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 what else should I be in? But the thing is, there's not much else to be in. What are you going to be in? Cash that has a 4% yield right now, and that's going down. You look at bonds, those yields are way down from 5.5% several months ago and a year ago. Those are down to 4 and change, and those yields are probably going down. I don't think it's going to drive the prices of bonds up huge because I don't think it's going to be a huge decrease in bond yields. But you look at it and you're like, okay, well, even the companies with low multiples, even the value stocks, they still have decent earnings growth out there. And I think you can't fight that decent earnings growth. Lowering interest rates, those are just forces that support the market.
So why so uncomfortable then?
Because
it's not like it's going up for no reason.
You know why? Because we were up 26% last year, 20+% the year after that. Before that, we're trading at almost 23 times earnings. It's just kind of too much, and it feels uncomfortable, and it feels frothy.
Two handfuls of stocks are trading at 23 times earnings.
Fair. But also that concentration in the S&P 500 makes people queasy, and I think that a lot of people are kind of all in on the S&P 500, and that concentration plus the multiples plus the couple of years in a row. Plus, we all have PTSD from when you have a couple of big up years, like something just happens and the market backs off. So there's a lot out there. There's geopolitical unrest. I think we're all freaking out a lot, at least we should be, about AI taking real white-collar jobs. None of these things are super near term, but they're out there and they're lurking in people's minds and making them uncomfortable. But at the same time, even me, I look across the whole asset class spectrum and I'm like, equities are kind of the only place to be right now.
Yeah, I mean, S&P's tracking for a 7% gain, Joe, in the third quarter.
So everything that Jenny just said that you would be troubled by, you could have said that on August 31st.
Yep.
And,
I did.
And again, this is not personal directed towards you, but this is the general overall perception of the market. The interesting thing about that is we had a lot of skepticism moving into the month of September. Where are we on the other side of that? The S&P's up greater than 3%. The Nasdaq's up 5%. So I think that caught people off guard, and I think that's important to understand when you're thinking about positioning and where we could go from here. Over the next couple of weeks, we're going to be waiting on earnings. This week, the focus is going to be on the labor report. You have the end of the quarter. So this week, I don't know that you have very much of an edge, but I think overall the secular bull market is in place until you tell me that earnings are going to defeat them. In addition to that, we're talking a lot about the Federal Reserve. There's also the understanding that global central banks, 86% of global central banks, by the way, their last policy action was a rate cut. So it's not just here in the U.S.
No, that's why Goldman today makes the call on the global equities to overweight. And they do mention global fiscal policies. And so they're in line with what you're you're talking about.
But there is still the remnants of, I think, the last 5 to 7 years where you have skepticism and you have underweight positioning as it relates going outside the U.S. Even myself personally, I'm not aggressively going to look outside the U.S. when I should be actually doing that. I've done that earlier in the year with the EIS, the Israeli ETF. That's the one area outside that I got some overseas exposure. But domestically, U.S. equities are giving me enough that I'm staying anchored there. And I think that's one of the reasons why you could see this run outside the U.S. last a little bit longer than people anticipate.
Jenny makes a good point. I mean, Doug McMillon, Walmart CEO, like, I can't think of a job that's not going to be impacted by AI.
Yeah.
Now, I guess we'll worry about it when we have to worry about it. Market doesn't seem to care about really anything other than earnings are good, so I can justify where we are, and the Fed's easing, so I can justify why we're going further.
I think the trouble with thinking about AI and the jobs that it's going to take and how that's going to impact the economy in the long run is that it's not going to be an overnight landslide. It's going to be a slow creep. So almost everyone I know right now who has a kid who's just graduated from college in May, they're sitting at home twiddling their thumbs, and they're in final rounds of interviews, and the big companies, like big major companies, are waiting to make that final hire because there's so much out there. So my thought on how that plays out is we see it creep. And we see the unemployment rate creep from like 4.2 now to 4.5.
Right, low hire, low fire. That's sort of the environment that you're in, right? Companies don't really know what the impact of AI is truly going to be on its workforce, so you're not really hiring as many as you normally would. Thus, you still can't get rid of maybe as many people as you otherwise would because you just don't know. And
then at the same time, when you ask how far does the market look out, I think that lens has shifted to a much closer looking out than it used to be. When I started, I always thought the rule of thumb was the market looks out 18 months-ish. Now I think people say rule of thumb is 6 to 12. Frankly, to me, it feels like 3 to 6. So if you're thinking the market looks out 3 to 6 or even 6 to 12, it's very hard to digest the fact that those job losses from AI are going to play out over the next 5 years and have a compounding painful impact.
So you know what you do? You know what you do? You continue to buy AI stocks. Yeah. That's what investors are doing. It's the tried and true place to be. That's why the trade continues to work better than anything else.
But I think the challenge there, too, is going to be the AI stocks right now, the primary AI stocks, many of them have pretty rich multiples. The first derivative AI stocks also have rich multiples. And when I think broadly about how this is going to impact us, everything can benefit.
But you know
from a corporate margin perspective. But everyone's going to benefit.
You understand this. I know you do. Right now, the market is not focused on what the multiple might be. The market, you have this force of momentum, and it's just, it is what it is. I mean, we could sit here and we could say we have all of these deteriorating potential fundamentals. They are concerns for 2026. Right now, the dominant force is that flow of capital that we characterize as momentum.
Well, that's why I tried, Bryn, to bring it that direction, because the NASDAQ is leading today. It's tech and comm services. NVIDIA, let's check it right now. NVIDIA is not at the highs of the day, but it was up better than 3%. It's up 2% now. The target goes to 220 from 205, reiterated by Jefferies. Chips across the board today. NVIDIA, Micron, AMD, Broadcom, they've all been higher. There are other names you could point to as well, but that's where the action is today.
Yeah, and, you know, Jensen this weekend was on one of your besties podcasts, Brad Gershner. I highly recommend people listen to it. And when, you know, Jensen's talking about not the billions, but, you know, trillions, which is a crazy number because a billion seconds is 32 years and a trillion seconds is 32,000 years. And so while I've always said Jensen is the master salesman, at the same time, he's delivered the goods. And I think if you can get past the circular financing that's happening with an Oracle and an OpenAI, which I don't own either one, I think that you still feel like the spend is massive. And to me, as long as, you know, the hyperscalers or cloud service providers don't do an Oracle and go negative free cash flow to, which I don't think they're even, that would be like almost impossible at this point, I think we're good. I think if we continue to see this, you know, strange financing, I would get more concerned. But as long as it's still going to settle around Oracle and OpenAI, I think the NVIDIAs, the Broadcoms, the Vertivs are just going to continue to move much higher.